Imagine you are sitting in a prometric testing center. You're staring down question 87 on the Series 65 exam, and your palms are just sweating.
Oh, yeah, it is the worst feeling in the world.
Right. The clock in the corner of the screen is ticking down relentlessly, and you're looking at this super convoluted scenario involving compound interest, risk-adjusted returns, and tax-equivalent yields.
Just a total nightmare scenario for a lot of people.
Exactly. And to solve this massive financial labyrinth, the testing center has provided you with a cheap plastic four-function calculator.
Yeah, the kind you might literally find at the bottom of a cereal box.
Like, you don't have a financial calculator. You don't have a scientific calculator. So you might as well be trying to perform open-heart surgery with a plastic butter knife.
It really is a terrifying moment for almost every candidate. It's that sudden, chilling realization that you are completely stripped of your digital armor.
Yeah, the flashcards are locked in your car, the textbook is at home, and that little plastic calculator just feels like a cruel joke.
But here's the thing, that moment of panic, it's entirely by design. They want you to feel that way.
Well, today we're actually going to show you why that plastic calculator is your secret weapon. Welcome to this deep dive.
Glad to be here.
If you are in your final prep week for the Series 65 or Series 66 exam, consider us your personal final week coaches.
We know you're facing a massive 130-question marathon.
Yep, and we know that somewhere between 10 and 15 of those questions are going to force you to do math.
Which is where the panic usually sets in.
Right.
Oh.
So our mission today is to completely demystify those math questions. We're going to take the terror out of the formulas for you.
And to do this, we've pulled together a massive stack of the absolute best study materials available.
What are we looking at today?
So we are synthesizing insights from CertFuel's specialized formula guides, the comprehensive textbook and practice exams from Achievable, and the actual NASAA test specifications.
Oh, wow. The literal test specs. That's huge.
Yeah, and we've even scraped real-world candidate debriefs from Reddit, where people are sharing the exact traps they fell into just yesterday.
I love that.
Right.
Real-time intelligence. So we're taking all of that and just distilling it down to the absolute essentials for you.
But before we look at a single abstract formula, we really have to establish the core philosophy of this entire deep dive.
Yeah, the lens through which you must view basically every single math question on this exam.
The foundational truth you need to internalize right now is this: you do not need to be a math genius to pass the Series 65 or 66.
I mean, just think about the restriction they place on you.
Exactly. They literally confiscate your scientific calculator and hand you a device that can only add, subtract, multiply, and divide.
So what does that policy actually reveal about the test writer's intentions?
Well, it tells me they aren't actually testing your ability to run complex polynomial equations or, calculate the natural logarithm of a moving average.
Right, because if they wanted you to do that, they'd give you the tools to do it.
Exactly that. The secret to passing this exam is conceptual understanding over rote calculation.
Concept over calculation. I like that.
The exam writers are just trying to determine if you understand the underlying mechanisms of finance. They want to know if you comprehend the relationships between different economic forces.
So they're basically asking, do you know when to apply this concept?
Yes, and more importantly, do you understand what the mathematical result actually means for the human being sitting across the desk from you?
Let's anchor this in a real-world scenario then. Let's step away from the abstract and follow a hypothetical investor who is trying to reach a very specific financial goal.
That sounds perfect. Where is the scenario from?
We pulled this scenario straight from the Achievable practice exams, actually, because it perfectly encapsulates how this test forces you to think conceptually.
Okay, set the stage for us. What is the client facing?
All right, so your client just walked into your advisory office. They just received a $200,000 inheritance from an aunt.
Okay, nice starting principle.
Yeah, and their ultimate goal is to reach $800,000 in liquid assets so they can comfortably retire early.
Makes sense.
They've done some reading on historical market performance, and they believe they can consistently attain an annualized return of 10% by investing in a diversified index fund.
Okay, 10% annualized. Got it.
So the question they ask you, and honestly the question the exam will ask you, is how long will it take them to reach that $800,000 goal?
That is a completely standard client interaction. They have a starting principle, a target number, and an assumed growth rate. They just want the time horizon.
Okay, but I am putting myself in the shoes of the stress test taker here.
Right, the person with the sweaty palms.
Exactly. I'm staring at my plastic four-function calculator. To solve this properly, I need to calculate exponential compounding interest.
You do? on paper at
I
least.
need to figure out exactly how many years it takes for $200,000 to compound up to $800,000 at a 10% growth rate. But there is no exponent button on this calculator.
Nope, none at all.
There is no way to do exponents.
Yeah.
How am I supposed to solve this without just guessing blindly?
That specific flavor of panic is exactly what the exam writers are banking on. They want you to stare at that cheap calculator and completely freeze.
Well, it's a trap.
It is, because if you have the conceptual understanding we talked about, you realize you don't need a scientific calculator at all.
Wait, really? What do I need instead?
You just need a mental shortcut that has been around for over 500 years. You need the rule of 72.
Ah, the rule of 72. I've seen it on the flashcards, but let's
Yeah.
actually unpack where this comes from because I think understanding its origin helps lock it into memory.
It really does. It's a fascinating piece of financial history, actually. This rule wasn't invented by some modern Wall Street quant with a supercomputer.
No? Who came up with it?
It was first published way back in the late 15th century, around 1494, by an Italian mathematician named Luca Pacioli.
1494. That is wild.
Yeah, he's often called the father of accounting. And fun fact, he was actually a close collaborator and friend of Leonardo da Vinci.
Wait, he knew Da Vinci.
He taught Da Vinci mathematics, actually. So Pacioli was trying to understand the nature of compound interest long before digital calculators even existed.
Right, he was just using a quill and parchment.
Exactly. And he discovered this brilliant, remarkably accurate mathematical anomaly. He found a simple mental shortcut to estimate exactly how long it takes an investment to achieve a 100% return.
In other words, how long it takes to double.
Precisely. How long it takes your money to double.
So how does Pacioli's 15th century magic trick actually work when I'm sitting at a computer screen in 2026?
It is beautifully simple. You take the fixed number 72 and you divide it by your expected annual rate of return.
Okay, 72 divided by the return.
Yep. The resulting number is the approximate number of years it will take for your initial investment to double in value.
Let's get really granular on the mechanics of that division, though, because this is where people make silly, unforced errors on test day.
They really do. It's a common stumbling block.
So if my expected return is 10%, do I divide 72 by 0.10 the way I normally would when doing percentage math?
No, and that is a massive trap. Do not convert the percentage into a decimal for this specific rule.
Oh, okay, so I just use the raw number.
Exactly. You use the whole integer. You simply take 72 and divide it by 10.
Okay, I'm tapping my plastic calculator right now. 72 divided by 10 equals 7.2.
That's it. It will take 7.2 years for your money to double at a 10% compounding rate of return.
Let's apply that back to our client's scenario. They are starting with $200,000 and they need to get to $800,000.
All right, walk through the doubling process. How many times does that initial principal need to double to hit the target?
Well, let's see. The first time it doubles, the $200,000 turns into $400,000. So that is one double.
Right, but they aren't at their goal yet.
No, they need $800K. So the $400,000 has to double again to reach the $800,000 target. That is a second double.
Precisely. The money must double twice. And because we know from our friend Luca Pacioli that one double takes 7.2 years at a 10% return.
And we need 2 of those doubling periods.
Exactly. So what's in the math?
I just multiply 7.2 years by 2, which gives me 14.4 years.
There you go.
So I can look the client in the eye and say, assuming a 10% return, you can retire in about 14 and a half years.
It's that simple.
I just solved a complex exponential compounding problem in about 15 seconds using only basic division and multiplication.
That is the exact level of math the exam requires. It's testing your resourcefulness and your grasp of the concept of doubling, not your ability to crunch logarithms.
But knowing how these exams are written, they don't just hand you this straightforward, forward-facing application of the rule, right?
Oh, definitely not.
They like to twist it to make sure you didn't just memorize a formula without understanding the mechanics.
They absolutely do. The test writers love testing concepts in reverse. It proves true mastery of the material.
So how does the rule of 72 work in reverse?
The beauty of the rule of 72 is that it is basically an algebraic seesaw. It works perfectly in both directions.
Okay, explain that.
If you know the interest rate, you can find the years. But if you know the years it took to double, you can just as easily find the implied interest rate.
Walk me through a reverse engineering scenario. What does that kind of question look like on the screen?
The screen might present a scenario like this. An investor placed money into a growth fund. Over the course of 20 years, the value of that investment quadrupled.
Quadrupled, okay.
Assuming a constant rate of compounding, what was the approximate annualized rate of return?
Okay, so if the investment quadrupled, that means it grew by a factor of 4. So say $10,000 became $40,000.
Exactly.
That means it doubled from 10K to 20K, and then it doubled again from 20K to 40K. So 2 doubles.
Correct. 2 distinct doubling periods occurred within that 20-year time frame.
So if 2 doubles took 20 years total, I just divide 20 by 2. That means a single double took exactly 10 years.
Yes. Now you have the time variable.
Right.
Bring back the rule of 72.
Right. So I take 72, and this time, instead of dividing by the interest rate, I divide by the number of years it took to double.
You got it.
So 72 divided by 10 years. Well, that equals 7.2. The annualized rate of return was 7.2%.
You nailed it. And the sources we reviewed, particularly the candidate feedback on Reddit, explicitly warn that you might see questions where the money doubles, quadruples, or even octuples.
Octuples, meaning it grows by a factor of 8.
Yeah, which is 3 doubles.
Right, 2, 4, 8. That makes sense.
As long as you can break the total growth down into the number of doubling cycles, the math always comes back to simply dividing 72 by the rate or dividing 72 by the years.
Okay, so let's jump back to our original hypothetical investor. They utilized the rule of 72. They patiently waited 14.4 years, and on paper, their $200,000 grew to a beautiful $800,000.
A great outcome.
Mission accomplished, right? They hit their number. Time to buy a house on the beach and retire.
If only finance were that simple. Because, as we know, the market does not happen in a sterile vacuum.
Oh, here comes the bad news.
Always. That $800,000 is a gross nominal number on a piece of paper. We need to measure what that investor actually gets to keep and spend in the real world.
Right. We have to peel back the layers of how returns are actually categorized and taxed.
Exactly. Because that 10% annualized return we assumed earlier was doing a lot of heavy lifting, and it obscures a lot of moving parts.
Let's break down the concept of total return then.
Total return is the absolute granddaddy of performance metrics. It is the most comprehensive way to measure performance.
Why is it the most comprehensive?
Because it captures absolutely every single way an investor can make or lose money on an asset over a specific period and divides all of that by the original cost of the investment.
So we're talking about a multi-pronged approach here.
We are.
We have to account for the dividends they received if they held stocks, the interest payments they received if they held bonds, and the capital gains or losses resulting from the actual price of the asset going up or down.
Formulaically, it is all income received, which means dividends and interest plus any capital gains minus any capital losses, all divided by the original cost.
Okay, but here is where we really need to stop and do a clear final week drill for the listener.
Let's do it.
Because the exam will test your understanding of capital gains mercilessly, and the terminology frequently trips people up.
It's true. The language can be very tricky.
So what is the absolute ironclad legal distinction between a realized capital gain and an unrealized capital gain?
Okay, this is vital.
Because, in everyday conversation, people use those terms totally interchangeably. But on the exam, confusing them will absolutely cost you points.
The distinction is entirely dependent on whether or not a transaction has actually occurred.
A transaction, okay.
An unrealized gain simply means the current market value of your asset is higher than what you paid for it, but you still own the asset.
You're still holding it.
You are holding it. You haven't sold it to anyone.
I always compare unrealized gains to the Zestimate of your house on Zillow.
Oh, that's a brilliant analogy.
Because let's say you bought your house for $300,000.
Mm-hmm.
You look on Zillow 5 years later,
Yeah.
and it says your house is worth $500,000.
So you have a $200,000 gain.
Exactly. You have a $200,000 unrealized gain.
Yeah.
And it's incredibly fun to look at. It makes you feel wealthy. You might even brag about it at a dinner party.
Of course you would.
But you cannot go to the grocery store and buy milk with your Zestimate. It is just glowing pixels on a screen.
It's not real money yet.
Right. It is phantom wealth until you actually execute a sale.
That is the perfect way to conceptualize it. A realized gain only materializes when the asset is actually sold and cash changes hands.
You sell the house, you get the closing check, the money hits your bank account. Now it is realized.
And this is crucial for the series 65 and 66 because the exam writers aren't just giving you a vocabulary quiz. They are testing if you understand the mechanism that triggers a tax event.
Right. The IRS does not care about your Zestimate.
They absolutely do not.
They do not tax phantom wealth. They only tax the closing check.
Exactly. You only owe capital gains taxes when those gains are realized through a sale.
So how might this look on the test?
The exam might present a scenario like an inventor's equity portfolio grew by 25% this calendar year due to a massive bull market. The investor did not sell any positions. What are the tax implications of this 25% growth?
The answer is 0. There are no tax consequences yet.
None.
The gains are entirely unrealized. The IRS cannot touch them.
Precisely. Understanding that mechanism is vital. Now, you mentioned the IRS, which is actually a great pivot point.
Oh.
Because even if you finally realize your gains, there are two invisible thieves that constantly operate in the background.
Oh boy, who are they?
They quietly siphon away the purchasing power of that total return. The two biggest thieves in finance are inflation and taxes.
Ah, yes. The silent killers of wealth.
So true.
Let's tackle inflation first because it's arguably the more insidious of the two. How does the exam expect us to adjust a client's return to account for inflation?
They want you to calculate what is called the real rate of return.
Real rate of return.
Yeah, whenever you see the word real in a financial context on this exam, it almost always translates to adjusted for inflation.
That's a great keyword association to remember.
And the formula is beautifully suited for your plastic calculator. You simply take the nominal return and subtract the inflation rate.
Okay, nominal just meaning like in name only, the raw percentage on the statement.
Right.
And the study materials note that on the exam, the inflation rate is usually represented by the CPI, the Consumer Price Index.
Correct. The CPI is the proxy for inflation. So let's say your client is thrilled because their statement shows a nominal return of 8.5% for the year.
Sounds like a good year.
But the government reports that the CPI for that same year was 4%.
All right, so I take the nominal 8.5%, I subtract the 4% inflation rate, and my real rate of return is 4.5%.
Exactly.
But let's explain the mechanism of why that matters. What does that 4.5% actually mean for the client's day-to-day life?
It means that while their account balance went up by 8.5%, the cost of groceries, gasoline, and healthcare went up by 4%.
Everything got more expensive.
Right. So their actual ability to purchase goods and services, their true purchasing power, only increased by 4.5%.
Wow, that cuts the celebration in half.
If they try to increase their lifestyle spending by 8.5%, they will quickly run out of money because the underlying currency is worth less.
So the real rate of return is the only metric that tells you if you are actually getting wealthier in terms of what you can actually buy.
That makes perfect sense. Inflation steals the purchasing power.
Okay, so now let's talk about the second thief, taxes.
Yes.
And this introduces a concept that is universally dreaded by candidates, but is one of the most heavily tested formulas on the exam tax equivalent yield.
Candidates dread it because it looks like algebra, but it is actually one of the most practical, real-world tools an investment advisor uses.
So what's the formula?
The formula is tax-free yield divided by the result of 1 minus the investor's tax rate.
Okay, before we crunch the numbers, let's explain the why. Why does this formula exist, and why do the exam writers care so much that we know it?
It exists because, as an advisor, you are constantly forced to compare apples to oranges for your clients.
What do you mean by that?
Specifically, you have to help them choose between municipal bonds, which are generally tax-exempt at the federal level, and corporate bonds, which are fully taxable.
Right. So a client looks at a list of bonds. They see a municipal bond issued by their city paying a 4% yield.
Okay.
And right next to it, they see a corporate bond issued by a massive tech company paying a 6% yield.
Human nature dictates that 6% is bigger than 4%. Right.
Exactly. So the corporate bond looks like the obvious winner, but that's a trap.
It is a massive trap because the IRS is going to take a bite out of that 6% corporate yield, but they aren't going to touch the 4% municipal yield.
So it's not a fair comparison.
Not at all.
Right.
So to figure out which bond is actually the better deal, you have to create a level playing field. You use the tax equivalent yield formula to gross up the tax-free yield.
Roast it up.
Okay. You are mathematically calculating what a taxable bond would have to pay in order to put the exact same amount of net cash in the client's pocket after the IRS takes its cut.
Let's run a detailed scenario to see how the mechanism works.
Sounds good.
Let's say our investor is highly successful. They are a neurosurgeon. They are in a high federal income tax bracket. Let's use 32% for this example.
Okay, 32% bracket.
And they are staring at that 4% municipal bond. How do I apply the formula?
You take the 4% tax-free yield and you divide it by the inverse of their tax rate. The formula says 1 minus the tax rate.
Right.
Since their tax rate is 32%, or 0.32, you subtract that from 1.
Okay, so 1 minus 0.32 leaves me with 0.68. This represents the percentage of income the client actually gets to keep.
Exactly. They keep 68 cents on the dollar. Now do the final division. 4 divided by 0.68.
I'm tapping my plastic calculator. Right. 4 divided by 0.68 equals approximately 5.88%.
There you go.
What does that number tell me, though?
That 5.88% is the tax equivalent yield. It tells you that for this specific neurosurgeon in the 32% tax bracket, a tax-free 4% bond is mathematically identical to a taxable bond yielding 5.88%.
Mathematically identical, I see.
Yes, if they buy either one, they end up with the exact same amount of money after taxes.
So if the corporate bond they're looking at yields 6%, they should actually choose the corporate bond because 6% is higher than their equivalent threshold of 5.88%.
Exactly.
But if the corporate bond only yields 5.5%, they are better off taking the 4% tax-free muni.
You have the mechanics perfectly, but here is the critical conceptual leap the exam wants you to make.
Okay, I'm ready.
Watch what happens to the math when we change the client.
Let's do it.
Let's say our client isn't a neurosurgeon. Let's say our client is a CEO pulling in millions, and they are in the highest possible federal tax bracket, the 37% bracket.
Okay, 37%.
We offer them the exact same 4% municipal bond.
Okay, so I do 1 minus 0.37, which gives me 0.63. They only get to keep 63 cents of every taxable dollar they earn. So I take the 4% tax-free yield and divide by 0.63, and that equals a tax equivalent yield of 6.35%.
Look at the difference there. The exact same municipal bond is mathematically worth 5.88% to the person in the 32% bracket, but it is worth 6.35% to the person in the 37% bracket.
That is fascinating. The higher the client's tax burden, the more incredibly valuable that tax exemption becomes.
Yes.
It essentially acts as a multiplier.
That is the exact conceptual takeaway, the exam tests. This is the underlying business reality of why municipal bonds are generally only recommended for wealthy clients in high tax brackets.
So how do they test that without making you do the math?
The exam will absolutely test this by giving you a scenario with a young entry-level worker making, say, $40,000 a year in a very low tax bracket.
Okay.
They will ask you what kind of fixed income investment is most suitable. If municipal bonds are an option, it is almost certainly a trap.
Because for someone in a 12% tax bracket, the math just doesn't work out. The tax exemption isn't valuable enough to make up for the lower initial yield of the muni bond. They are better off just buying the corporate bond and paying the small amount of tax.
Precisely. You have to understand the mechanism of who benefits from the tax code.
Okay, so we've navigated inflation, we've navigated the tax code. Our investor finally has a realistic, net of everything view of what they actually get to keep.
Good for them.
But now, we encounter a totally different problem.
Naturally.
Our investor opens their mail, and they are looking at two different documents regarding the mutual fund they invested in, and the numbers completely contradict each other.
This brings us to a massively tested concept, where candidates consistently lose points if they don't understand the underlying human behavior being measured.
Human behavior.
Yeah, the critical difference between time-weighted returns and dollar-weighted returns.
I am going to set up a vivid scenario for this, because the mechanism behind this discrepancy is just wild to me.
Go for it.
All right, our investor opens the Wall Street Journal, or they look up their mutual fund on Morningstar. The publication proudly states that the fund achieved a 10% return for the calendar year.
The investor is thrilled, obviously.
Of course. But then they log into their actual personal brokerage account to look at their personal end-of-year statement.
Uh-oh.
And their personal statement says their return for the year was only 4%.
Huge difference.
How is that legally possible? Are they being robbed by the brokerage?
They are not being robbed by the brokerage. They are being subjected to the consequences of their own human psychology.
Okay, break that down.
To understand why those numbers are different, we have to dissect how they are calculated, starting with the number published in the newspaper, the time-weighted return.
Okay.
I refer to this as the manager's scorecard.
The manager's scorecard. Okay, explain the mechanics of how it is calculated.
Time-weighted return assumes a completely sterile theoretical world. It assumes a perfectly disciplined buy and hold strategy for the entire performance period.
So no trading.
No trading. The math assumes that one lump sum was invested on January 1st, and not a single penny was added, and not a single penny was withdrawn until December 31st. It calculates the compounding growth over time, but it completely and intentionally ignores the actual cash flow behavior of the investing public.
Why on earth would the industry standard metric be one that explicitly ignores the reality of how people put money in and take money out?
Because it is the only fair way to grade the actual fund manager.
The manager.
The Achievable textbook gives a great real-world example here. Will Danoff, who has famously managed the Fidelity Contra Fund for decades.
Sure, legendary manager.
Will Danoff controls the portfolio strategy. He decides which tech stocks to buy, which healthcare stocks to sell, and how to allocate the fund's capital.
Right, he's the captain of the ship.
But Will Danoff does not control the passengers. He does not control the investing public.
Ah, I see where this is going.
Imagine the stock market drops 5% on a random Tuesday due to a scary news headline. 1 million retail investors panic.
They usually do.
On Wednesday morning, they all log into their accounts and hit sell, demanding their cash back.
And Danoff has to pay them.
Yes. Danoff is suddenly forced to sell off massive chunks of his portfolio to raise the cash to pay those panicked investors, even if he strongly believes the market is going to bounce back on Thursday.
So his performance is being handicapped by the irrational fear of the public.
Exactly. And conversely, if the market is booming, everyone dumps money into his fund at the exact same time.
Which forces him to buy stocks when they're at their absolute most expensive.
Yes. A mutual fund manager is a victim of public cash flows. So the time-weighted return isolates his stock-picking skill.
It strips out all the noise.
It mathematically strips out all the public deposit and withdrawal behavior, so we can answer one specific question: is Will Danoff actually good at picking investments?
Which explains the 10% number our investor saw in the newspaper. That was the time-weighted return. Will Danoff had a great year. His stock picks grew by 10%.
Right. So why did our specific investor only get a 4% return on their personal statement?
That is answered by the dollar-weighted return.
The dollar-weighted return. This metric abandons the sterile theory and embraces the messy reality. Dollar-weighted return factors in the exact timing and the exact size of every single deposit and withdrawal that the individual client made throughout the year.
Walk me through how a client's behavior drags a 10% fund return down to a 4% personal return.
It's the classic tragedy of market timing.
Okay, let's hear it.
Let's say the mutual fund had a massive rally in the first 9 months of the year. Our investor was sitting on the sidelines in cash, watching the fund go up, feeling FOMO, fear of missing out.
We've all been there.
Finally, in November, right when the market is hitting an all-time high, the investor gets a huge year-end bonus and dumps all of it into the mutual fund.
They bought at the absolute peak.
Yes. And then in December, a geopolitical crisis hits and the market drops heavily.
Oh, no.
Even though the fund manager made great picks early in the year and finished the year up 10% overall, our investor had very few dollars invested during the months the fund was going up.
And they had a massive amount of dollars invested during the 1 month the fund crashed.
Exactly. The weight of their dollars was concentrated in the worst possible time period.
So their personal dollar-weighted return is going to be terrible, potentially even negative, despite the fund's overall positive year.
The fund manager succeeded, but the investor failed because of terrible timing.
So dollar-weighted is really just a mathematical mirror reflecting the client's own behavior back at them.
It is. Or, to be fair, it reflects great behavior if they manage to buy the dip. But statistically, human psychology drives us to buy high out of greed and sell low out of fear.
Right.
The dollar-weighted return captures that reality.
As a final week coach, how do I systematize this for the exam? Like when I'm reading a paragraph-long question, how do I instantly know which metric they're asking for?
You focus entirely on the subject of the question. Who is being evaluated?
Who's being evaluated? Got it.
If the question asks you how to evaluate the performance of the portfolio manager, or if it asks you how to compare the performance of two different mutual funds against each other to see which has the better strategy.
The answer is time-weighted return.
Always.
Manager equals time-weighted. That's a good mental shortcut.
But if the question asks how to evaluate the client's actual performance, or if it specifically asks for a return metric that accounts for client cash flows, deposits, or withdrawals,
then the answer is dollar-weighted return.
Client equals dollar-weighted. That is a solid, unbreakable rule.
Client equals dollar-weighted. Oh, that's incredibly helpful.
And if we connect this dynamic of evaluating performance to the broader arc of the exam, it leads us perfectly into the next major hurdle.
Which is what?
Well, because up to this point, we've figured out how to calculate the returns, we've adjusted them for taxes and inflation, and we've accounted for the investor's bad timing.
Right.
But we still haven't answered the single most important existential question in all of finance: were those returns actually worth it?
Right. As the Cert Fuel material so beautifully puts it, chasing returns without considering the risk you took to get them isn't investing. It's just gambling with a nicer vocabulary.
Exactly. And that brings us to the heavyweights of the exam risk-adjusted returns, Let's establish the core problem here.
Okay.
Imagine two different portfolios, Portfolio A and Portfolio B. At the end of the year, they both report a time-weighted return of 12%. On paper, they look identical.
But the journey to that 12% was wildly different.
Exactly. Portfolio A achieved that 12% by buying boring, stable, dividend-paying utility companies and just holding them patiently.
Right, low stress.
The portfolio value barely fluctuated. Portfolio B, however, achieved that same 12% by day trading volatile, speculative tech stocks on margin.
Sounds exhausting.
Portfolio B was up 40% in March, down 30% in July, and swung wildly every single day, keeping the investor awake at night with anxiety before finally, exhaustedly, landing at 12% on December 31st.
They both made the exact same amount of money, but Portfolio B required enduring massive amounts of stress and the very real possibility of total ruin.
So how do we mathematically measure the efficiency of that 12%?
We use risk-adjusted return ratios.
We do.
And the two absolute titans that you must master for the series 65 and 66 are the Sharpe ratio, developed by Nobel laureate William Sharpe, and the Trainer ratio, developed by Jack Trainer.
Those are the big ones.
Okay, I am acting as the proxy for the stressed student right now. I am looking at these two formulas on my cheat sheet, and I literally want to tear my hair out.
Why is that?
Because the top half of the formula, the numerator, is exactly the same for both of them.
It is. Both the Sharpe ratio and the Trainer ratio begin by calculating what is known as the risk premium.
Okay, the risk premium.
The formula for the numerator is simply the portfolio's actual return minus the risk-free rate.
Let's explain the logic of that numerator. Why do we subtract the risk-free rate? And what even is the risk-free rate in the real world?
The risk-free rate is universally represented by the yield on a 90-day U.S. Treasury bill.
A T-bill.
Yes. It is considered risk-free because it is backed by the taxing authority of the United States government. The chance of default over a 90-day period is theoretically zero.
Okay, so what's the logic?
The logic of the numerator is this. If the risk-free T-bill is paying 3%, you could earn 3% by doing absolutely nothing, taking zero risk, and sleeping perfectly soundly.
So if my wild day trading portfolio B made 12%, I don't get credit for the full 12%. Because I could have made 3% in my sleep.
Exactly. You subtract the 3% risk-free rate from your 12% return. You are left with 9%.
And that 9% is my risk premium.
Yes. It is the extra return you generated specifically as a reward for taking on risk. Both Sharpe and Trainer use that exact same 9% numerator.
Okay, so if the top of the fraction is identical, why on earth do we need two different formulas? What is the functional difference?
The entire difference, and honestly, the absolute key to passing these ratio questions lies entirely in the denominator, the bottom of the fraction.
The bottom of the fraction, okay.
It is all about how these two economists chose to define the word risk.
Okay, let's take them one at a time. Let's start with William Sharpe. What does the Sharpe ratio use to divide that 9% risk premium?
The Sharpe ratio divides the risk premium by the portfolio's standard deviation.
Standard deviation. Man, that is a heavy statistical term. What does it actually measure in a way that a normal human can understand?
Standard deviation measures total risk. It measures absolute volatility.
Absolute volatility.
It looks at the historical data and measures how wildly and how frequently the portfolio's actual returns swing away from its average historical return.
Give me an analogy that doesn't involve the stock market, because I think that helps separate the math from the concept.
Let's use your daily commute to work.
Okay, my commute.
Let's say your commute takes 30 minutes on average. If the standard deviation of your commute is 2 minutes, that means your commute is incredibly predictable.
Right.
You might arrive in 28 minutes, you might arrive in 32 minutes, but you are never stressed. You know exactly when to leave the house.
Okay, so low standard deviation equals high predictability. Got it.
But what if your average commute is still 30 minutes, but the standard deviation is 20 minutes?
Oh boy.
That means one day it takes 10 minutes, and the next day there is a massive accident and it takes 50 minutes.
So I have to leave way earlier.
Because of that massive unpredictability, that high standard deviation, you have to leave your house an hour early every single day just to be safe.
Right.
The unpredictability causes you massive stress and costs you time. That is what standard deviation measures in finance, the unpredictability of the journey.
And the exam expects you to know a bit about the statistics of that unpredictability, right? Specifically, they test the concept of the normal bell curve.
Yes, they do. You don't have to calculate standard deviation by hand. That would be basically impossible on a plastic calculator, but you need to know the probabilities of the bell curve.
Okay, what do I need to know?
If a mutual fund has an average return of 10% and the standard deviation of 6%, the exam wants you to know the 68, 95, 99 rule.
Let's translate that rule into dollars and cents. How does it work?
The rule states that in a perfectly normal market, 68% of the time, the fund's return will fall within one standard deviation of the average.
Okay, so 10% minus 6% is 4%, and 10% plus 6% is 16%.
Exactly. That means 68% of the years, you will earn somewhere between 4% and 16%.
And 95% of the time, returns fall within two standard deviations.
Yep.
So two standard deviations is 12%. 10 minus 12 is negative 2%. 10 plus 12 is positive 22%.
Correct.
So 95% of the time, my return will be somewhere between losing 2% and making 22%.
Exactly. So the Sharpe ratio takes your 9% risk premium and divides it by that standard deviation. It asks the question, how much excess return did I get for every unit of total unpredictability I endured?
So a higher Sharpe ratio means a more efficient portfolio.
Exactly.
I want to plant a flag here because this reliance on the normal bell curve feels a little too neat and tidy for the real world.
It does, doesn't it?
And I know we are going to circle back to the dangers of that assumption later.
Yeah.
But for now, let's contrast Sharpe with Trainer.
Let's get it.
If Sharpe divides by standard deviation to measure total risk, what does Jack Trainer divide by?
The Trainer ratio divides the exact same risk premium by beta instead of standard deviation.
Beta. We hear that word constantly on financial news networks. Let's unpack the mechanism of beta. What does it actually measure?
Beta measures systematic risk.
Systematic risk.
Systematic risk is the risk inherent to the overall macroeconomic system. It is the risk you cannot diversify away, no matter how many different stocks you own.
Oh, like if the whole market tanks.
If a global pandemic hits, or the Federal Reserve massively hikes interest rates, or a war breaks out, it doesn't matter how well diversified your portfolio is. The entire market is going to drop. That is systematic risk.
And beta measures how sensitive my specific portfolio is to those massive system-wide swings.
Exactly. By definition, the overall market, usually represented by the S&P 500, has a beta of exactly 1.0. That is the baseline.
So let's ground this in business reality. Why would a company have a beta higher or lower than 1.0?
Think about a highly speculative tech startup. They rely on cheap borrowing, and their revenue relies on consumers having lots of discretionary income.
Right.
If the economy booms, they explode in value. If the economy enters a recession, they might go bankrupt. Therefore, their stock swings much harder than the overall market.
That makes sense.
That tech startup might have a beta of 1.5. That means it is 50% more volatile than the market. If the S&P 500 goes up 10%, the startup is expected to go up 15%. But if the market drops 10%, the startup crashes by 15%.
And what about a low beta?
Think of a regional water utility company. It doesn't matter if the economy is booming or in a deep depression, people still have to flush their toilets and wash their dishes.
Right, the revenue is incredibly stable.
Exactly. So the utility company's stock doesn't swing wildly. It might have a beta of 0.5. It only moves half as much as the broader market.
So the trader ratio looks at that beta and asks, how much excess return did I get for every unit of systematic market risk I took?
Precisely. Now we arrive at the ultimate exam mastery tip. This is what separates candidates who pass from those who fail.
Okay, lean in, everyone.
The exam will give you a scenario and ask you which ratio to use. You must know the when. When do you use Sharpe and when do you use Trainer?
Give me the rule.
You use the Sharpe ratio when you are evaluating an entire standalone portfolio.
Why? What is the logic behind that?
Because if a client only possesses one single portfolio, they are entirely exposed to all the risk inside that portfolio.
Oh, I see.
They are exposed to the systematic market risk, and they are exposed to the unsystematic risk of the specific companies they happen to own.
Right.
Standard deviation captures all of that volatility. It captures the total reality of their situation. Therefore, Sharpe is the only accurate measure.
Total portfolio equals total risk,
Right.
which equals standard deviation, which means we use Sharpe. That makes logical sense. So when do I use Trainer?
You use the Trainer ratio when you are evaluating a single investment, like a new mutual fund or a specific stock that you are adding to an already fully diversified portfolio.
Okay, slow down. Why does the fact that the existing portfolio is diversified change the mathematical formula I use?
This is the absolute magic of modern portfolio theory. If a portfolio is already fully, perfectly diversified across hundreds of companies and sectors, it has mathematically eliminated virtually all unsystematic risk. The good news from the healthcare stocks cancels out the bad news from the energy stocks. The unsystematic risk is gone.
Ah, so the only risk remaining in that massive, diversified portfolio is the systematic market risk, the risk that the whole system crashes.
Exactly. So if you are analyzing a new tech fund to see if you should add it to this already bulletproof diversified portfolio, you do not care about the tech fund's standard deviation.
Because it'll just get blended in.
Right. You don't care about its total risk because its unsystematic risk will instantly be neutralized the moment it enters the diversified portfolio.
You only care about how this new fund reacts to the overall market.
You only care about its systematic risk. You only care about its beta. Therefore, you must use the Trainer ratio.
To summarize, for everyone frantically taking notes in their car right now, if you are judging a standalone entire portfolio, use Sharp. If you are judging a single piece being added to a diversified puzzle, use Trainer.
Mastering that distinction, understanding the mechanism of why diversification changes the formula, is easily worth 2 or 3 points on the exam.
We have covered the journey, we've covered the erosion of returns, and we've covered the risk metrics. Now, let's step directly onto the battlefield. Let's look at the specific mathematical traps the exam writers have meticulously set for you.
The exam writers are incredibly clever. They know exactly which concepts candidates try to memorize blindly without understanding the underlying mechanics.
And they exploit those gaps without mercy.
Absolutely without mercy.
Let's start with the trap that gives everyone the most nightmares: bond yields.
Oh, bond math.
Specifically, yield to maturity. I am looking at the formula for yield to maturity on the CertFuel cheat sheet right now, and it is an absolute beast.
It's terrifying.
It has brackets, it has addition over subtraction, it has division inside of division. Am I expected to memorize this algebraic nightmare and execute it on a plastic calculator?
Emphatically, absolutely no.
Oh, thank goodness.
The NASA test specifications clearly prioritize the relationship between the various bond yields over the actual raw calculation.
The relationship.
Yes, they do not care if you can crunch the algebra. They want to know if you understand the mechanism of how bond prices and bond yields interact in the open market.
But reading a list of bullet points that say when price goes down, yield goes up, just scrambles my brain. I need to visualize it. How do I lock this relationship into my memory?
You need to visualize a seesaw, a literal physical playground seesaw.
Okay, I am picturing a seesaw.
The fulcrum, the pivot point right in the center of the seesaw that bolts it to the ground, is the coupon rate of the bond.
Coupon rate.
The coupon rate is the nominal interest rate printed on the physical bond certificate. It is fixed. It never ever changes for the life of the bond.
So the fulcrum is bolted down, the coupon is fixed.
Now imagine the bond's market price is sitting on the left end of the seesaw and the yields are sitting on the right end of the seesaw.
Okay, got it.
Let's talk about the mechanism of a discount bond. Why would a bond trade at a discount?
Let's walk through a scenario. Let's say I own a bond with a fixed coupon of 5%. I bought it for its par value of $1,000. But a year later, inflation spikes, and the Federal Reserve raises interest rates. Now, brand new bonds are being issued, paying 7%.
And suddenly you have a medical emergency and you need to sell your bond. You go to the open market. What happens?
Well, a buyer looks at my bond and says, why on earth would I pay you $1,000 for a bond paying 5% when I can buy a brand new bond for $1,000 that pays 7%?
Exactly. Nobody wants your bond.
Nobody wants my bond. So to entice a buyer, I have to put it on sale. I have to lower the price to, say, $900. I have to discount it.
Exactly. The bond is now trading at a discount. Its price is lower than par. So, on our visual seesaw, the price end on the left goes down.
Which means the yield end on the right is thrust up into the air.
Yes, because the investor who buys it for $900 is still getting the same fixed interest payments based on $1,000. Plus, they make a $100 profit when the bond matures at par.
So their total yield goes up.
And the exam wants to know the exact order of those yields as they go up the seesaw board.
What's the order?
From the fulcrum outward, the order is always the same. Current yield, then yield to maturity or YTM, then yield to call or YTC.
So for a discount bond, where the yield end is pointing up, the relationships from lowest to highest are the fixed coupon is the lowest number. Current yield is higher than the coupon, YTM is higher than current yield, and YTC is the highest point of all.
Perfect. Now, what happens if the economic environment reverses? What if interest rates plummet and new bonds are only paying 3%?
Well, suddenly my old 5% bond is highly desirable. Everyone wants it. So I can charge a premium for it. I can sell it for $1,100. The price goes up.
So the price end of the seesaw goes up in the air, which means the yield end crashes down to the dirt.
Yes, and the order of the yields on the board stays exactly the same. They're just pointing down now.
Right.
So the fixed coupon rate at the fulcrum is now the highest number. Current yields is lower than the coupon. YTM is lower than current yield. And YTC is the lowest point of all, hitting the ground.
This visual is so much more powerful than trying to crunch algebra.
It really is.
If the exam asks you a conceptual question about a 5% bond trading at $1,100, which you know is a premium, and they ask which yield is the lowest, you don't need to do any math.
I know the price is up, so the yield seesaw points down, and YTC is on the absolute end of the board, so YTC is the lowest.
Exactly. You just answered an incredibly complex bond math question using zero actual math. You use conceptual mechanics. That is the secret to dominating this exam.
Okay, let's hit some rapid-fire exam traps that we pulled straight from Reddit forums.
Let's hear them.
These are the exact tricks that actual test takers reported falling for this week. Trap number 1, the beta of 1.0.
Oh, this one. The trap here is psychological. Because 1.0 sounds like a baseline, like the number 0, candidates assume that a beta of 1.0 means the investment has no risk.
Right, it feels neutral.
But as we explored during our trainer ratio discussion, a beta of 1.0 means the asset has the exact same risk as the overall market.
And the market is risky.
Very. The S&P 500 has a beta of 1.0. And as history shows us, the S&P 500 can easily drop 20% or 30% in a single year.
So an asset with a beta of 1.0 carries massive systematic risk.
Exactly. If a client tells you they want an investment with absolutely zero market risk, you don't look for a beta of 1.0. You look for an asset with a beta of 0, like a 90-day treasury bill.
That makes total sense. Trap number 2, negative alpha.
This one is incredibly tricky because it preys on our linguistic instincts. Alpha is a metric derived from the capital asset pricing model, or CAPM.
And what's the trap?
The trap is assuming that the phrase negative alpha means the portfolio lost money.
I fall for this immediately. If I see the word negative applied to a performance metric, my brain immediately pictures red numbers and a furious client who lost their life savings.
And that assumption could be completely false. To understand why, you have to understand the mechanism of CAPM.
Which is?
CAPM is a formula that calculates what a portfolio's expected return should be based on the risk-free rate plus a risk premium determined by its beta. Alpha is simply the difference between what CAPM expected the portfolio to do and what the portfolio actually did.
Walk me through a scenario where negative alpha doesn't mean losing money.
Let's say the stock market is roaring. Based on the amount of risk a manager took their beta, the CAPM formula predicts that their portfolio should have made a 15% return this year.
Okay.
But at the end of the year, the manager's stock picks were a bit sluggish, and the portfolio only achieved a 12% return.
Wait, 12% is still a fantastic positive return. The client made a ton of money.
They did. But the actual return of 12% minus the expected return of 15% leaves an alpha of negative 3%.
Oh, wow.
The manager generated negative alpha because they underperformed mathematical expectations for the specific level of risk they took, even though they still generated a massive profit.
So negative alpha simply means underperformance relative to risk, not necessarily an absolute loss of capital.
That is a classic devious test writer trick.
Unbelievable. Okay, final trap, NAV timing. Net asset value timing for mutual funds.
This is a purely operational regulatory rule, but it shows up constantly because it dictates how clients buy and sell.
Oh, so
Mutual fund net asset value, the NAV, is calculated exactly once per day at 4:00 p.m. Eastern Time when the New York Stock Exchange closes. This mechanism is called forward pricing.
why do regulators insist on forward pricing? Why can't I just buy a mutual fund at 11:00 a.m. for whatever it is worth at 11:00 a.m. like I do with a stock or an ETF?
Because a mutual fund is a pool of thousands of different assets. It takes time to calculate the total value of all those assets.
Makes sense?
Regulators mandate forward pricing to prevent market timing arbitrage. If you could see that European markets were up at noon and buy a global mutual fund based on yesterday's closing price, you would be stealing value from the long-term holders of the fund. Forward pricing ensures everyone buys and sells blindly at the next available calculation.
So if I submit an order to buy a mutual fund at 3:30 p.m. Eastern,
Your order is locked in, and you will receive that day's 4:00 p.m. price, whatever it turns out to be when the math is finalized.
but what if I live on the West Coast? I get off work, I log into my brokerage app, and I submit an order at 1:01 p.m. Pacific Time, which is 4:01 p.m. Eastern.
You missed the regulatory cutoff by 60 seconds. You do not get today's closing price.
So what happens?
Your order goes into a holding queue, and you will execute at tomorrow's 4.0 EPM price. This is heavily tested because if you misquote a price execution time to a client, you are violating regulatory standards.
So looking back at everything we've covered,
Mm-hmm.
the Rule of 72, the tax equivalent yield, the seesaw, the risk ratios, what is the grand unified theory here?
The grand unified theory.
Yeah. When a candidate is sitting in that prometric testing center, looking at a math question, what should their mindset be?
The mindset shift is realizing that you are not actually taking a math test. You are taking a reading comprehension test that happens to use numbers as the vocabulary.
That's the optic.
They are testing if you understand the definitions, the regulatory constraints, and the economic mechanisms that govern those numbers.
Trust your conceptual knowledge over the plastic buttons.
Yeah.
If you calculate an answer and it conceptually contradicts the seesaw or it violates the logic of the Rule of 72, you did not discover a new law of physics.
No, you did not.
You just pushed a wrong button. Trust the concept.
That is exactly right. Let the concept guide the math, not the other way around.
To wrap this deep dive up, remind yourself that you only need to survive a handful of these calculation questions out of a 130-question exam. You are armed with the tools.
You are ready.
You doubly understand the difference between the total risk measured by Sharpe and the systematic risk measured by Trainer. You know that time-weighted returns grade the manager, while dollar-weighted returns grade the client's timing.
Yes.
You understand the mechanism of realized capital gains. Look for the relationships. Draw the seesaw on your laminated scratch paper the second you sit down, and you will dominate this section.
And as you head into your final weekend of study sessions, I want to leave you with one final, slightly provocative thought to mull over.
Ooh, let's hear it.
It's a concept that the exam hints at, but the real world exposes ruthlessly. We have spent this entire deep dive rigorously discussing mathematical formulas, the Sharpe ratio, the Trainer ratio, standard deviation, CAPM, and every single one of these formulas relies entirely on historical data. They rely heavily on the statistical assumption of normal bell curve distributions of risk.
Which we mentioned earlier.
Right. They assume that the future will behave roughly like the past.
Right. As we discussed with the standard deviation commute analogy, the models assume the roller coaster is fundamentally predictable.
Exactly. But this raises an incredibly important, almost philosophical question about the limits of quantitative finance. What happens to all of this pristine math when a true black swan event occurs?
A black swan. An event that is entirely unpredictable carries massive impact and shatters all existing models.
Yes. A global pandemic that shuts down the entire planet's supply chain in a matter of weeks. A sudden, unprecedented geopolitical shock. An algorithmic flash crash triggered by AI trading bots.
Terrifying stuff.
In those moments of sheer systemic panic, the historical correlations completely decouple. Assets that the models promised were totally uncorrelated suddenly all crash together at the exact same speed.
The playground seesaw physically snaps in half.
It does. And if standard deviation fails to predict a total systemic market freeze because a freeze doesn't exist on a normal bell curve, we have to ask ourselves a difficult question.
Which is?
Are these mathematical models actually protecting investors? Or are they just giving both the advisor and the client a false sense of scientific security in a market that is fundamentally driven by irrational, unpredictable human behavior?
Are we just using math to hide from chaos? It is a fascinating question and something to think about as you step into the testing center.
Definitely.
Your plastic calculator certainly cannot predict the future, and the pristine formulas might fail during a black swan. But your deep conceptual understanding of why the market works the way it does, that is the only thing that will allow you to guide a client through the chaos. Good luck on the exam.